Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Kavana. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Kavana, CIO of Old Farm Partners. Our goal is to bring great investors and their themes they're working on. Some are under the radar, and we think all are experts in their disciplines. I'm excited today because we have Edgar Allen, who's the founder of High Ground Investment Management in London. Welcome, Edgar.
Thanks, Kieran, and thank you very much for having me on the podcast.
I'm very excited to have you. Trust me, you're one of the more eloquent guests we'll have, I promise, but also you're a great investor, so this is awesome.
Well, you may not think so much by the end of the podcast, but
wait, unless you had
to start off that way.
Did you have a terrible month? Well, anyway, we'll get to that. Let me just give a little background on Edgar. He runs a long-short equity fund in Europe, focused on Europe, and has done an admirable job since he launched in 2019. Certainly been through a few ups and downs with COVID and everything else, but you've done a very good job. Edgar is really good pedigree that any mother would love, where he worked for TCI, run by Chris Hone. He worked for Massadiki at Naya, as well as stops at Fidelity and BlackRock. He got his degree from Cambridge University in pathology, which Americans will have to define what that degree is, by the way, because I had to look it up. But I'd love to get into your background, and maybe to kick it off, Edgar, it would be great to just a quick rundown of how you got to the place you are in today.
Sure, absolutely. Really, I got interested in investing when I was 16, and I was in a car crash, and I got some insurance money from that, £1,500. And I asked my father, what should I do with this money? And he, like all responsible parents, said you should punt it on the stock market. And so that's what I did. So I put it all into one company, a company called Trafalgar House, which was a proper 80s style conglomerate, a big construction company, owned the Ritz Hotel, owned some cruise liners. So a real ragtag bunch of assets. And then just a couple of months after I bought these shares, then there was a raid from the Jardine Flemings, dawn raid on the shares from Hong Kong. They're trying to get some money out of the country. And the stock went up by 22.5%. And I sold my shares and thought, this is great. And so I carried on investing through my school years and then through my time at university as well. And it was sort of different back then because this is before the internet, and there wasn't all that much information out on companies. I mean, I could see the stock prices, and the other thing that I had almost an unlimited supply of was annual reports. Because the FT, they did this free annual report service. You didn't even need to buy the newspaper. You just got out this little page. You ticked as many boxes as you like. You sent it off, and then the companies would send you their annual reports. So there'd be no presentations. There'd be no explanation about how to read an annual report or anything like that. But I was growing up in rural Suffolk, which is like the UK's equivalent of Iowa. So a lot of grain, a lot of sugar beet, and not a lot to do over the summer holidays. And so I had these big piles of annual reports, which I used to read through, and gradually sort of piece together why things were what they were. Depreciation. It seemed like a bad word generally, but it all came up as a positive. The cash flow statement. It's like, well, why is that? And also was always quite interested as to why what seemed to be really quite important data was often hidden in the sort of the 40th footnote in page 200 of an annual report. I was like, I wonder why they're doing that. So sort of that's how I sort of learned about companies, learned about accounting, had successes and failures in my own personal investing. did find that I was always a bit of a value hunter. After something had fallen a lot, I was like, oh wow, this is probably good value. But did learn painfully that you actually kind of wanted to wait until it stopped falling. Maybe after it bounced up a bit, that was actually a bit of a safer time to buy it. So learned some lessons, but really that's how I got into investing and always enjoyed it. But I was also I did sort of science A levels. I was also really always been interested in how things work. And so at university, as you said, I did pursue sciences. Did a degree in pathology, which is really the study of disease. Whereas medicine is you study disease and you study how to cure it. Pathology, I just know a lot about the disease part without being able to do anything about it. But I can say, I know exactly what's going wrong, but I don't know how to fix it. So that's what I did. Ended up doing most of my work in heart disease as well, a role of antioxidants in heart disease. But then when it came to the end of my university career, then I was really faced with a choice. So I could stay in science or leave. And in my final time at university, I've been doing some research. I've been doing these experiments. Each experiment would last a week, and I'd go into the lab every day and do one of hundreds of steps, normally involved diluting something or spinning something down. And then at the end of this week, then I'd end up with a computer printout, which is the results of the experiment. And when this came out, my heart would nearly always sink. Because somewhere along the way, something had gone wrong. And so the results, it wouldn't be like a negative result, it'd just be gibberish. The controls would run off. I'd take it to my supervisor. I'd already know what he's going to say, which was like, it hasn't worked. You've got to go and do it again. And the problem was that my success rate, like 20% of my experiments working, was really best in class. It was regarded as a fantastic achievement. I wrote a paper about it. But for me, I was like, this is too much. So I really enjoyed the learning bit, but then you kind of get to the end of the motorway, and then you kind of handed like a pick and said, look, there's a wall of granite, go and chip away. So full respect for people who stay in scientific research, but it wasn't for me. But the other thing I knew a bit about anyway, and did enjoy, was investing. So I tried to pursue a career there.
Wow, interesting. So coming out of university, I'm sure you thought about doing medicine, right? And then you went to your version of Wall Street in London. I mean, I'd love to hear how that arc went, and then how you got to launching your own firm.
Yes, that's right. So I decided that I wasn't going to pursue a medical career, but that I was going to go into finance. I went to all the asset managers in London and applied for a job from all of them, and they all turned me down. They all said no chance. And so I went back to them and said, look, this is obviously, you've made a mistake here. You really should give me a job. And Fidelity then relented and said, oh, okay, all right, then here you go, have a job. So I started at Fidelity in '97. Very grateful for them for giving me that opportunity. And right at the start, then I started off on what was called the electronic sector, which was defined as anything which uses any electricity in any of its functions that any other analyst doesn't want to cover. So it was the most random group of companies that you could imagine, like zinc galvanizers, or guys making lamp leads, or semiconductor fabs, just the whole gamut of random companies. And then quite quickly they gave me the software sector. And then when the internet came along, they were like, oh, well, you may as well do this. It seems like your sort of thing. So I did all the .com companies, all the tech companies, all the IPOs. In Europe during the dot-com boom. Spent a lot of time on the West Coast as well from my colleagues from Boston. Very interesting time. Seeing the likes of like PayPal and Webvan, and did the ARM original IPO meeting. I was the only one from Fidelity there.
Wow.
All the PMs pulled out, just me and the management. So really, really, exciting times. Most of that period doing an IPO a day. I mean, really, crazy volume of new issues on the market. And then I was approached by this startup tech hedge fund called Avocet in 2000, offered me a partnership position, and that was very exciting. I left Fidelity and joined them, and that's when I started shorting. So I've actually been doing long only professional investing for the last 28 years, and shorting for the last 25 years.
Oh, yeah, and then I would love to know if you don't mind, and it's ironic you went through that period. I'm sure it's made you a good short seller, because the Amazon survives and the web vans didn't, right? But
Yeah,
no, a lot
yeah.
10 to 1 kind of ratio. But what about working at TCI? That's where I encountered you actually in your
Mm,
career. And TCI, people don't know, Chris Holmes, probably one of the more famous investors in the world,
mm.
definitely in the line of the Buffett, maybe not quite yet, but right up there. So maybe can you talk about that a bit?
Absolutely, yes. I mean, I think Chris was introduced at the Norges conference as Europe's finest ever investor, and I think that's a fair accolade for him. And definitely really enjoyed working for him. I was at TCI for 6 years, and look, Chris doesn't think it's an easy world out there. He thinks it's a tough world, and if you're making a high return on capital, then somebody's going to come along and try and take that away from you. And you have to have a good reason that they're not going to make it. That you're going to be able to hold on to it through thick and
Yeah.
thin, and so that's I totally agree with that. Really, he's very focused on duration. You're very focused on quality companies which can really do well and compound for very long periods of time. And I say that I started out a little bit different. I've got much more of a valuation focus these days. Look at his
You
fund.
do.
He's got some things which are a bit more expensive. I'm a bit more scared about the world, and so naturally gravitate to somewhat cheaper companies.
Well,
But that core thing, I totally agree with.
Well, it probably don't you think allowed you to launch your own business too, because they became famous, and it was like, as an allocator, what do we always say? They'd say, you should look at Edgar Allen's fund. And my immediate question would be, where did he work? Right? Where it's like
Yeah.
the modern, like, where's he from? What knighthood was he? But he's from TCI, and everyone would be like, wow, that's in the US, it's like Viking or somebody like that level. I'm sure it gave you that kind of ability to to launch your business.
Absolutely, they're definitely very helpful. Obviously, you're a very well known fund. Had great returns while I was there, but also after I left.
Yeah.
So I wouldn't put it all down to me, certainly.
No, certainly not. I don't. Yeah.
But
Okay, great. I'd love to segue into your investment style, because I definitely think of you as a long-term investor, longer term, probably in terms of your underwriting than many investors I know. So maybe you could go through that a bit, and then how you apply that same lens to the short side.
yeah, absolutely. So, I mean, really, I think when you look at investing, there are two sorts of investing you can do. Your one is that you buy something and then you hope to sell it to somebody at a higher price, and this might be because they're coming up with a new product, or they're going to be able to take costs out of the business, or they're going to beat next quarter's earnings, or it's a new management team, or the chart looks good. There's some reason why I think somebody else is going to pay more for it in the future. So that's one form, and the other form is you buy something because you think it's cheap. And I'm really very much in the second camp. So that's why we invest. We buy these companies because we think that they're fundamentally cheap. Now, the big problem with that is that nearly always you then need to look a very long way into the future. Now, this is not actually through choice. If you said to me, look, I've got this company and I'm really confident about the next 5 years, they're going to do really absolutely well over the next 5 years. After that, I don't know so much. And it pays out a 30% dividend a year. I'm like, okay, look, I'm interested in that. Yeah, because I get all my money back, I get a decent return, and I get an option on the future. If the thing goes horribly wrong in year 6, it's still okay. I've still made a reasonable return there. But those opportunities are very, very rare. In fact, you very rarely find companies even with like a 10% dividend yield, where they can maintain it for the next 10 years. Like it's super rare to find those kind of opportunities. And so really the other sort of companies which are really genuinely cheap are companies which can do well for very long periods. But unfortunately, you really have to go a long way into the future. So if you find a company which is like not terribly expensive, trades at 5% free cash flow yield, you get all of that money back in terms of dividends or share buybacks each year, and it can compound that cash flow organically at 5% a year, for the next 27 years. Then the business runs into difficulty and fades over the next decade. So it's almost a 40-year holding period, but you're buying in the 27 good years ahead of you. You make an 8% IRR, which is it's okay, but it's not great. Yeah, but you're still got 27 years ahead of you. And if you want to find something which is actually cheap, that it really has to do well for a very long, for a very long period, before it gets wiped out. And if it's got faster growth, then it does help a bit. But if you found a company, say, with a 2% dividend yield, which can grow its earnings at 20% a year, and it manages to do that for 15 years straight, and then the business gets wiped out, that's a 3% IRR. So it's pretty hard to find businesses which can compound at 20% a year for 15 years straight. One of the biggest problems, I think probably the biggest problem with an equity investor, is that whether you like it or not, you're invested in these very long duration assets.
Right.
And I'd say that duration is the thing which is most mispriced by the market, because it's partly because people think, well, hey, if I'm owning this company for 3 years, that's or 6 months or something, I don't really care what happens in year 10 or 13 or 15, because I'm long gone.
Right.
That's one of the things. And the other thing is that actually quite a lot of the basis of our valuation, things like EVAs and DCFs, we've got this concept of terminal value. And this is the idea that a company you buy today is going to be generating a stream of free cash flow for its shareholders in 100 years' time, in 200 years' time, in 300 years' time. And this is like very nice on a spreadsheet, but it is absolutely not the real world. In the real world, companies are formed, they grow, and they fail. And across society, that takes about 8 years on average. Now, for listed companies, they last for longer than that. But these aren't things which last indefinitely. They're all wiped out in the fullness of time. And I got asked by an investor recently. She said, "Look, I'm a bit worried because you say you invest in these companies, but in your presentation you say you think they're all going to get wiped out." I'm like, yeah, I think they all are going to get wiped out. I think that's actually a very safe bet that any company you invest in today is going to be wiped out, and it will turn into a zero. And it's just the time frame that's going to take.
This is along the lines of Keynes, right? In the long term, we're all dead, right? I mean, that's generally,
In the long term,
I mean, so then how do you? I know obviously you don't take a 40-year view, but you think about these things, right? But then how do you what is the right setup? And actually, you're at a hedge fund, right? So I know, and I read all of your letters, and you move around a bit. You do have some that when I first met you pre-launch, you do have some of the same positions, but not all of them.
That's right.
So then how do you do that? How do you? I would imagine you're just constantly updating your views based on their earnings and how you're reading through. Is this durable? But you tell me.
Yeah, absolutely. But that's definitely a big part of it. Like, are these durable franchises? But the other thing is that the good thing in the market is that you've always got the opportunity to go to things which are doing better. So if you own something, say, look, I'm really confident here, I'm going to make a 13% IRR. You might do much better than that over the first couple of years, and then the IRR falls away, and then something else might fall out of favor in the market, and you're able to buy that at a bargain basement price. And so there are two reasons really to sell one of these names. One is that you start to be concerned about the durability, and the other reason is actually you find something else which is better. And we've got quite a few companies that we'd love to buy, but they're just too expensive. So if you look at like a franchise like Moody's, it's a big TCI position. One that I used to work with Alex on, and I mean, I love that franchise. It's got like a incredible 100-year growth record, but it's just too expensive for me. So if it fell a lot, then I'd be like, oh right, really interested.
But this is the bane though of like, my father was an investor too, and I remember talking to him. He's like, Google forever has just been a little too expensive for my entire career. Do you know what I mean? Like, and now here they did $100 billion in revenue last quarter. It's just that is the hard part about have a value orientation.
Yeah. I mean, for sure, you're definitely going to miss out on some names. But I think it's an industry where you can't be too upset about the things which do well, which aren't in your wheelhouse. There are definitely some things they go up a lot, and we're like, oh man, we really should have done that, because that was really the kind of thing that we should have been on. And other stuff like Nvidia, it's like, well, it's not really going to be for us. We can't complain that we didn't own it, because wouldn't really have fitted with our style. And so that's we're not too concerned about that. We're just really trying to execute well in our areas.
Yeah, and you've done a great job. You're having a really breakout year, actually, big
Thank
time, I
you.
think. Yeah, very well done. But before we get to I want to just talk about Europe. But first, what about the short side? I mean, you actually are one of the more disciplined short sellers, and we're actually going through one of these periods currently where there's a lot of like short. We're in the squeeze territory for a lot of stocks. This is like
Yeah.
GameStop again. So how do you handle it?
Yeah, I mean, well, we're having a, very, very good year on the shorts this year. They made us absolute money this year, in a pretty strong market.
Good.
So we're very, very, very pleased by the performance this year, and actually performance over the last 6 years has been consistently good on the short side as well. So that's definitely which has gone well. Hopefully, will continue. I've jinxed it now. But really, on the short side, we're really looking for these businesses where you look at them and go, hey, look, this is going to be a worse business in 3 years than it is today, and that's normally because of increasing competition. Mostly, companies provide a pretty good product or service, and their ability to price is something which is constrained by competition. So it's really changes in competition is the number one thing that we look at. It's quite interesting. Some of the most valuable things that you get as an individual, nobody makes any money out of. If you get septicemia, you go to hospital, your life is saved with a shot of penicillin. I mean, that probably costs $5, and the guy making it probably makes 50 cents and 7% return on equity. I mean, like if you had that back in the day, you could have gone to Queen Victoria and said, "Look, I'll save Prince Albert." I mean, you would have got like Australia for that injection.
Yeah,
So
right.
it's incredibly valuable for you as an individual, but companies don't make any money because generic drug manufacturing is just so competitive. And so that's really what we look at. Really, is the competitive environment. That's the key. And then what we a big part of it is really seeing evidence of this deterioration already coming through in the numbers, and a lot of that is coming through in changes in the P&L, changes in the cash generation. So if you've got to take a company where you've got declining gross margins, that's often a really bad sign. Companies cutting R&D spend, so they maintain profits, but you're eating into future sales by cutting R&D or cutting marketing. Also, a lot we see a deterioration in cash conversion. So if you're running a company, you've got quite a lot of latitude actually in order to maintain the P&L, but it has to fall through somewhere. So it normally comes through in the cash flow. And so when we see these companies say that, so they're capitalizing R&D or they're factoring or reverse factoring, capitalizing costs, these are all starting to make acquisitions. These are all areas where we look at and go, okay, this is you can see evidence that the management you're under pressure, and we particularly like it if the numbers that people are using, the numbers that brokers are using, the numbers that management are guiding people to, are actually getting increasingly divorced from the economic reality of the company. So we're not great short sellers if the companies that have been doing great and now we're saying, oh, now it's going to inflect. We're much better when we can see like returns have been going down for the last 5 years. Gross margins have been going down, cash conversions is low and declining, and it's trading at quite high multiple. This kind of things, we're like, oh, okay, yeah, this is like very much in our kind of zone. We've really got to understand what's causing these changes to the business.
Very interesting. Not to not to market because we're not allowed to, but you've done a great job. You've beaten the Euro stocks and you have much lower net exposure and a lot less volatility. And as I was saying, you had a great year. I just would love to shift a little bit just to get your opinion about Europe as an opportunity set, because I hear that all the time about Europe related to Trump, related to the war in Ukraine and deficit spending coming to Germany and rearming and all that stuff. But like, I know you don't have to make a case for Europe, how it's turning around here. But I do think that investors, when they're looking at geographies, they worry about growth.
Yeah.
And so I would love to hear why you think your area is a good area to invest in.
Yeah, and I think that's that's a very valid criticism of Europe. I think to start with, actually, European returns over time have actually been pretty good. So interestingly, if you look at like stock market returns, US versus Europe, 1920 to 2008 in dollars, then they're exactly the same.
Really?
Periods of European outperformance, periods of US outperformance. But over that time period, you've had the same returns. You've had a hugely different return profile since 2008. Now, over that entire period, then what you've seen is that you've seen dollar strength, European currency weakness, and you've also seen much faster growth in the US. much faster GDP growth over that entire period. But what you've seen in Europe is you've seen high dividends, and that's the thing which has equalized the actual returns that you've made as an investor. And if you look at the valuation difference between Europe and the US, it's much higher than it is normally. So there's a big gap. But if you said, look, let's have a look over the next 50 years, do you think the US is going to grow faster than Europe? I say yes. That's like a solidly right up there. That's like a 99 percentile kind of answer. It's like, we've been pretty confident about that. But I'm also very confident that European stocks will give you higher dividends. And it's the interplay of those two things which will determine your returns. And look, there are some good things about Europe. To start with, Europe is just much poorer than the US. Your average salaries in Europe are half of what they are in the US. It's not like a small difference. And so some European companies have this like massive advantage compared to their US peers. Obviously we look at companies like Boeing and Airbus, and like one thing which people don't really talk about is the fact that Airbus can hire an aerospace engineer, with the same qualifications, very similar productivity in Hamburg, for half the price as it costs in Seattle. And so that means you can have more of them. And so you're less likely to run into problems. You're less likely to have door plugs fall out. You're less likely to put in things like the MCAS system because you've just got more engineers. So it's just a structural advantage that you've got by having this lower cost European workforce. So that's one starting point. The other point, obviously, is healthcare. Healthcare expenses are much, much lower in Europe. They don't sit on the companies. They're borne by the governments. As well. So that's another advantage that Europe has. There's actually really a big difference in the starting positions from a deficit standpoint. Like if you look at Europe, you look at Germany, 60% debt to GDP, pretty low ratio of indebtedness compared to most other countries. You look at countries like Italy, primary budget surplus. You look at like Greece, Portugal, Ireland, big budget surpluses, even after interest expenses. And then even in the UK and France, obviously the budget deficits are too high in both those countries, but they're much lower than the US, and they're falling quite fast. So it's definitely better from actually a sovereign and a deficit standpoint. It's a much stronger starting position. Also, European households have delevered a lot as well, so much less individual debt in Europe. So I say, look, there are definitely some European advantages, but on the other hand, definitely stronger US growth, and also US companies on average do make a higher return on equity. So I'm not saying that they should trade at the same valuation. European companies should the same valuation as US companies. They're definitely not. But the level of discount is very high at the moment.
And you make a great point. You also don't have to be right about Europe. You just have to be right about the 10 large things that you own, or 10 to 12. You know what I mean? Which there are some great European companies, but the conditions are interesting. Actually, those are some things I hadn't thought about, really. Super interesting, actually. I'd love to, could you give us an example maybe of one of your ideas that you mind, just one big core name that you think, and just walk through it and why you think it has duration?
Yeah, let's talk about Knorr-Bremse. This is it's a German company.
What was it? Sorry,
it's a modern name, Knorr-Bremse.
Okay, got it.
Knorr, and then Bremse.
Oh wow, okay, cool.
Yeah. So look, this is it's an interesting company. One thing obviously we look at, if you're going to look out, we were very interested in competitive dynamics and how that's changed over time. And so for Knorr, we really we look at their major competitor today on the train braking side is Wabtec. And so if we go back in time, we go back to 1890. Their major competitor was Wabtec. So you've had a completely stable competitive environment for the last 135 years. So that's a really interesting starting point. And it's not like you haven't had people try to break into the market. So you had Siemens. They spent billions of dollars, came up with their own braking system, and Siemens also make trains. So they say, hey, look, we make the trains, we've made our own braking system. We're just going to integrate it with the trains, cut out these other dodgy Germans, but they got zero customers. Zero customers took it up. Everybody said, no way. Give us the Knorr brakes. And the reasons And the reasons why that's the case is because there's more than 100 years of R&D behind this braking system, and it's been through a lot. So this new guy, you're like, well, have you tested it on ice? Yes. Have you tested on wet rails? Have you tested when there's leaves? Have you tested when it's leaves and ice and wet? And you just don't really know.
I guess brake systems are really important.
Yeah. It's not an easy sell. You say, hey, look, we've got a train going 120 miles an hour. Yeah. Why don't you be the first guy to try this brakes on it? Like, well, maybe I'll go for the one that we've tried before.
Fair enough.
What's also interesting about these kind of situations is it's actually it's some of the issues are not even just to do with the system. Say the Siemens system was actually as good. Yeah, but all of your engineers, they know how to use the NOR system. So you use a Siemens system, the guy puts in the disc the wrong way around. Yeah, the train crashes and kills everybody. Siemens says, well, that's not us. Okay, it's your engineer putting it the wrong way around. Be like, yeah, but he wouldn't have put the NOR on the wrong way around because he's been working with that thing for the last 30 years. So some of the barriers are actually not even about how good the system is, but they're also about the actual inherent know-how that's built up inside the entire industry. So NOR is a company where it's got this very stable, competitive situation that's going on, where we can really say, well, look, is it going to change a lot over the next 30 years? We really don't think so. We think it's going to be a stable, competitive situation. We think that train travel is going to be a growth market over the next 30 years. We also think that what we've seen consistently is countries get richer, then they become less tolerant of accidents. And so the amount you're willing to spend to stop somebody dying in a train crash goes up every year. So that's a great benefit to you if you're doing the safety systems. Also, if you're running a train network, what you like to do is run trains faster and you like to run them closer together. The two things you need better braking systems for. So as well as the growth in train travel, obviously you're seeing a lot of train lines being laid down around the world. There's also these inside developed markets, there's also these drivers for growth and increased spending on these systems. If you look at the track record, NOR's got a phenomenal track record. It's grown its top line at a 9% CAGR for the last 42 years. That's pretty pretty impressive. You're not finding many things with a stronger long-term track record than that. And it does have this attractive system where you sell the systems, and then you have high margin recurring revenues coming from the consumables in the braking system. So that's one where we think there's strong long-term duration.
Yeah, very interesting. That's cool. I hadn't known that. That does check your box on 40-year, which is rare, right? But that's pretty cool.
Well, I think there are some other ones actually out there. I
know that.
I'd say that, the defense industry is also quite good like that. I mean,
I wouldn't mind actually. Do you mind shifting into defense for a second? Just because you've seen a huge run up in like Rheinmetall and a few others. But what do you think now?
Yeah. Well, if you look at European defense spending, it's likely to grow by about 80% over the next 5 years. So there's a huge secular tailwind right now in the industry. But one thing which is very attractive about defense is it's a very consolidated market. And there's normally just one person you're going to go to. So like if you want to go and buy, if you're in the UK, you want to buy an aircraft carrier, there's one person will sell it to you. If you want to buy a fighter jet, there's one person you can go to. If you want to buy an anti-submarine frigate, there's one person. The submarine, one person. There's all BAE. but it's the same in the US. If you're in the US, you want to buy an aircraft carrier. There's only one guy who will sell one to you. If you want to buy an attack submarine, but both General Dynamics and Hunter Ingalls will both make them. They're both making the same type of submarine. If you want to buy an F-35, there's only one person you can go to. So it's very consolidated, and all these programs have very long lives. If you look at BAE, they recently won the AMPV that replaces the M113. This is a multi-purpose tracked armored vehicle. But the M113 that came out in 1960. And you look at it, and there's not a BAE program. They made money continuously on that for the last 60 years. And it's a case of whatever you look in defense. I mean, so if you look at like the mainstay of the US bomber force, the B-52, Boeing started to get paid in that project in 1946. Those planes will start to be retired in the early 2040s. So Boeing's making money on that program for nearly 100 years. And actually, even the airframes are the same airframes which were fought in the Vietnam War. So they're just these things. They're very long duration programs. So you can you can really say, well, we can really put a long duration on the cash flow streams that the companies are generating. So from that standpoint, I think it's a very attractive industry. Obviously, we've seen a big run up in valuations. So like BAE, it's like a day one investment for us. It is a much smaller position now. We have sold it down this year, but that's just being reflective of a big expansion in the multiple.
Yeah, very interesting. Yeah, very cool. Another very long duration example. I appreciate those. Could you talk about actually maybe real quick, just want to switch to money management because as an example, 22 is a bad year. S&P was down 20. Most markets were down similar. You were up on the year, and I assume that was probably some good value investing plus strong short selling. If you apply kind of everything you're talking about investing, it's similar in that you're compounding and not losing a lot of money in short, which can really interrupt that compounding. We're talking about the, this wonder of the world that Einstein used to talk about. So maybe could you talk about like how the interplay between good longs, good shorts and compounding and probably not selling too much so you create a lot of taxes along the way?
Yeah, absolutely. I mean, so I think those are all great points. I mean, so if you're making 100% nearly every year, apart from the year where you lose 100%, then you don't have a great track record at the end of that. So,
and by the way, I won't even tell you how many people, Edgar, don't understand when I say you're down 50 and you have to make 100.
Yeah,
they're like, what? No, I
right.
I have to make 50. I mean, it's amazing that they are in this business, but go ahead.
Yeah, no, that's absolutely right. I mean, they're just very, these losses they're very painful to make up.
Right.
And so, look, we really want to, we really want to be in these things which we think are fundamentally cheap, but they tend to attract more people in tougher times, because people, they get more interested in strong balance sheets, they get more interested in low price to book, they get more interested in dividend yields, things like that. So they tend to migrate a bit towards us. So as you say, they tend not to get hit so hard in the market sell-off. And then on the short side, we're naturally these are business models under more pressure. They've got lower margins to start with. They've got much more indebtedness, and so they have a tougher time of it in those type of market environments. So we certainly we definitely hope to significantly outperform our market exposure in a tough year like 2022. But on the other hand, we're probably in a very strong tape. Generally, I'd say we may not completely keep up entirely with our market exposure on the other side.
Yeah, I know, but it helps not to lose that big chunk of money and then crow about your last 3 years of returns, but right from the beginning. Because I'm starting to see that now, by the way, because it's been a while now since 22, and a lot of people are saying, well, on a 3-year basis, we're annualizing at 30, and then you look back and they were down 40 in 22.
Yeah,
so not losing is the strategy.
Absolutely. I mean, it's a huge benefit if you can avoid those big negative years.
Yeah. Could I shift back into something just very interesting because I allocate to hedge funds as my normal job, and it's interesting how many people have a science or engineering background and are in this business. And I was wondering because I've read most of your letters, and you always have some pithy, interesting, I would say, liberal arts or observation about the world or in the animal world or something. And I remember you said, look, one time you said that Carthage had the most valuable real estate in the world, and then it was completely worthless after the Punic Wars. Greece invaded or Athens, and but so what do you think that is? Like maybe that it's not all math. Do you know what I mean? Like it's not accounting and finance only, right? You came from a science background and probably have applied some interesting principles.
Yes, absolutely. Well, I mean, I've always been really interested about how things work, and certainly having a bit of a basic understanding of chemistry, biology, physics really helps with that. And some people I worked with early in my career, they were like, I can look at this company and it's a pulp producer, or it makes chemicals, or it makes airplanes. I don't care. It's all just numbers on a spreadsheet. And the job doesn't make any difference what the actual company does. And I've never been in that camp. I've always been very interested in actually what the company does, and how it works. and why a customer will pay the price that they will for the product or service they're getting. So those have always been big questions for me, and I think that there's certainly having a bit of a scientific background helps. But as you say, also interested in history and how things have changed over time. Because if you're going to say, look, something is is a long duration asset, well, you've got to look back and see if that's held true. And obviously, I think in general, like real estate in major cities in the world, it's actually have been pretty good long duration assets because these cities have been quite challenged. So if you look at like a city like London, major city in the UK, for the last 1,500 years, but over that period of time, it's had fires and floods and plagues and wars and rebellions. So it's had a lot of challenges and it's got through them all. But a counterexample of that, as you say, is you go back a bit further. You do have Carthage, which is interesting. Yeah. From a real estate standpoint, because Carthage was a preeminent power in the world, the richest and most valuable city in the world, and not only that, it was enclosed by these incredibly thick city walls, and so it was a very enclosed actual real estate space. So it's a bit like the Manhattan, but like magnified, because you didn't want to live in Queens back then. You really wanted to be inside the walls. And so it went from being like the most expensive real estate market in the world, and then, as you say, after the Third Punic War, the Romans destroyed the city completely, forbid anybody from living there, and in fact salted the earth, so that like nothing would grow. So you couldn't even graze a goat on what was the remains of Carthage. And so it quite literally went from being the most valuable real estate market in the world to the cheapest, which is something which we've never seen before or since, fortunately. So that's a sort of interesting, an interesting counterexample to the real estate.
Well, I mean, maybe it has a very interesting. It was the Roman. Sorry, I forgot. But is the I read a great book about how Germany, hyperinflation. It was almost the same thing, in that Americans came in, swooped in after World War I, and were buying real estate, and because they had a worthless currency, and look at the dominoes that fell after that. And so it's a creative process, isn't it, to like just keep your mind open to opportunities, right? I mean, I always get a kick out of looking back a decade or 2 decades or 3 decades ago on what were the top 10 market caps, and it's really amazing, right? I'm sure you do that too.
That's that's hugely interesting. I totally agree, and it's phenomenal how much the composition of the indexes change over time, and the actual companies disappear, and sometimes even like the actual composition. Like you look at the US index, obviously they're dominated by banks. Then entirely dominated by railroads, and then moving into industrials, and now into technology. So just huge index changes that we've seen over time. And then this very interesting question today, whether where we've had this period where we've had the dominance of the largest companies has carried on for much longer than usual, and that's against a trend where dominant companies having shorter lives. We had this sort of counter trend rally, whether this is a new paradigm, or whether it's just like one of those other counter trend rallies we've seen in this slightly jerky but downward trending chart over time. So that's very interesting point. Obviously, we're a very concentrated market at the moment, and a huge amount of the overall market value residing in the Magnificent Seven. And that's I think probably the biggest single question, if you look at the market over the next 10 years, is how that will play out.
Well, it's just you hesitate this time. It's different, but I have been thinking about this, that OpenAI came out. I mean, it wasn't even a company a few years ago, and it's suddenly a challenge to mega scale companies. And we'd never seen something like that, right? Do you know what I mean? Like it would normally take time and build, and all of a sudden this company comes out of nowhere and is 13 billion in revenue. Still is wildly overvalued from a top line standpoint, but maybe not in 10 years. It is very interesting.
Well, the adoption curve generally has been increasing over time, and OpenAI is the latest example of that, where it's like times are from 0 to 100 million users, and you look at like canals or railways or electricity or televisions, radio, television, washing machines, and it's just gradually increased. And then OpenAI comes out and gets there faster than ever before, and that itself is a big worry for the incumbents and effectively for equity investors.
Has that changed how you think about it? Because I was looking back at your initial note when I met you before you launched, and some of the names are the same, but some of them are very different. And you also seem very valuation sensitive. And now, I would say from just reading the progress of your letters, you're studying businesses as maybe you were back then, but at least you're articulating it more. Is that affected how you think this technology is really taken over kind of everyone looks through a lens of technology, no matter what, right? Whether you're Siemens, you're a technology company, whether you're Google, you're a technology company.
Well, I think that we'll see tremendous change, over the next 20 years, and that's also something which, in general, humans find quite hard to visualize.
Right.
I mean, if you look at our evolutionary history, like not much changed. So we have the Stone Age, the Bronze Age, and the Iron Age, and people kind of think, you sort of intuitively think that maybe they're about the same length of time, but actually, as a species, more than 99% of that period was spent in the Stone Age, and not much went on. So I've got this collection of axes in the office, and if you look at an axe from 15,000 years ago, or one from 400,000 years ago, like, there's not much difference. Yeah,
Right.
not a lot happened over that period, and so like as a result, our ability to sort of anticipate future technological changes is quite low. And so if you said to me, look back over the last 25 years, we've had the internet, we've had the genomic analysis, you have mobile telephony, and then you said to me, like, are we going to see more changes than those huge changes over the next 25 years, or fewer? I'd say, and then my head would say more, but my heart would still say fewer. How could it be more?
Yes.
How can you have something which is bigger than the internet? I mean,
Right.
what is that going to be? But it's likely that we will see bigger changes, and that's going to impact the great majority of companies, and it's probably going to be very challenging for equity holders.
Does that mean that management is very important? Because you have to net more. I mean, obviously they're important, but maybe even more important because the time frame, the adoption curves are so accelerated.
It's always been difficult for incumbents to sit on a new change, and people criticize them for this, and it's just. But the problem is, you've got your own business, but also you've only got a limited number of people working on things, and you're really up against everybody else in the world. And so generally, if you look at like big changes, it's mostly not the guys who were previously leading in the industry who take over. I mean, the guys making horse carriages didn't turn into autos, despite the fact that a lot of the work was actually the same. Like actually making the actual car part was actually the core carriage makers originally. It was pretty similar. And then the auto guys didn't make planes, and the newspapers didn't turn into search engines. And if you see a change, the first thing you see isn't something which is going to be good or bad. The first thing you see is a change, and from experience it's probably going to be bad. As an analyst of a company called Gretag, and they were a great business. They were by far the world's dominant manufacturer of machines which processed photos. So people would go on holiday, they take photos, they take the film out of the camera, they go to the pharmacist, chemist, and they'd hand it over and say, hey, look, develop these photos. They would then either do it in-house with a Gretag machine or send it off to a lab further away, also using Gretag machines. So then we had this advent of digital cameras, and we saw them and they said, look, this is going to be great for us, because what's going to happen is, like, the number of photos taken is going to go up by tenfold from today. Like, people are literally going to take 10 times as many photos, but they're only going to print out half of them. Okay, so for our market size to go up by 5x, it's still pretty amazing. We're like, wow, that's incredible. Yeah, you're going to do so well out of this whole digital photography thing. Well, it didn't work out that way, and it wasn't because the 10 times number was wrong. Actually, so that we took a lot more than that. I mean, like the number of photos, obviously, it's just gone up by a factor of 1 million. But it was the fact that just people just basically stopped printing them out completely, and so that's normally the normally thing you see is the change. Like if you're a newspaper. In 1995, and you say, look, the internet is going to be the best thing ever for us. We'll be able to get subscribers all around the world. That guy living in Kampala can now pick up the New York Times, couldn't do it before. Not only that, we're going to get rid of all those print unions. They're all out. They've been obeying us for the last 100 years. They're all gone. All of our distribution costs, like all the bits taken off by the news agents and stuff, that's all gone as well. No more paper boys, everything. And not only that, we'll even be able to run like personalized adverts for these guys. Instead of having to show everybody the same thing, we can segment it. It's going to be like, you think our franchises were worth something before, they'll be worth 1,000 times more in this post-internet world. And look, they might have been right, but they probably wouldn't be. And the reason is because when you have a big change like that, it's normally the incumbents normally miss out. But they're also a great story about it.
Right, they got their lunch eaten by Google and people who fed them them ads and such, and it's super interesting. I mean, one last thing I'd love to go through with you is you see unusually investor friendly terms, and you feel like you have social responsibility as a portfolio manager and a successful investment firm. So I'd love to hear your quick thoughts on that. And it's definitely, I hear it more in the UK than I do in the United States, but I find it admirable and interesting.
Thank you. Well, certainly for the investor terms, they really thought, what would I like to see as an investor? So reasonably low fees which decline with assets, then a performance fee, which isn't, you have a good year and a bad year, you still charge a performance fee, it just crystallizes once every 2 years, a hard hurdle rate, before you get any performance. So these are all the sort of things that which I thought I would like if I was an investor. So that's the reason why why introduce those terms. And to the second point, certainly, I think you're working at TCI, seeing what Chris has done with the foundation there. I think that's very very inspiring. So I think we do in this industry, we do have social obligations, and that's obviously we're in a very privileged position. I mean, allocation of capital is a super important job for society and a very interesting one. So we're very very privileged position to be doing the job, but also we do have to look to the broader impacts on society and on the world from how we both how we make the money, but also how we choose to spend it or give it away.
Well, that's great. Well, Edgar, this is a good one. I think we covered a lot of ground, the Bronze Age right through Carthage, right through current tech trends. So well done.
Yeah.
I really appreciate your time. Edgar Allen, thank you very much.
Thanks, Kieran.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Kavanagh. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.